Hello, everybody. Welcome to a special edition of Monday Market Must-Knows. My name is Merlin Rothfeld. Now, last week in the financial markets, you heard about some sensational activity. The retail investor taking it to Wall Street, gaining back power. Well, we're going to filter through a lot of that media news that you've read and heard about, which might be a lot of misinformation, and get down to the brass tacks, the truth from a trader's perspective. Here to help me break it all down, we've got Larry Jacobson joining us from Online Trading Academy. Larry, welcome.
Thank you, Merlot. How are you doing today?
I am absolutely fantastic. I love what's going on in the trading and investing world with all of this Robinhood, Wall Street bets thing. It's great, but let's start with a basic understanding of what happened from your perspective.
Well, this is nothing new. In fact, it brings me back to a story when I was in college. You and I were talking about this the other day, where I remember when Rocket came out by Herbie Hancock. And what was really interesting to me was I was hearing these other students saying, have you heard about this new guy, Herbie Hancock? Isn't he amazing? Well, Herbie Hancock's been a well-established jazz musician on several albums long before Rocket, but it's funny that when somebody hears things for the first time, they kind of spin it as they're in the know. And I think this was a great example of a bunch of people now coming off the momentum of actually starting and saying, maybe we can beat the market and bring the market to its knees. But this is, to me, nothing that's new out there that couldn't be taught with some good education.
You know, it's funny, when I first started taking classes on Trading Academy back in the day, my mentor actually was talking to me about short squeezes. And I was kind of reminiscing when I heard all this information, because the media makes it seem like this is a brand new event. Like, wow, they discovered this little niche thing that's never been seen before, and it couldn't be further from the truth. I mean, a short squeeze is something that has been around since the dawn of financial markets. Well, actually, since they've allowed us to short these financial markets. So give me a little bit of a rundown on what a short squeeze is.
Sure. Well, let's presume right now the first thing that scares a lot of people who don't have good education is just the idea of what shorting is. I mean, if you think about it, you're borrowing shares of stock from a broker and you're trading in the open market by selling it. Now, the goal is to actually see price go lower. So eventually what you do is you buy back the actual shares at a reduced price and you return those shares virtually back to the broker. Now, what happens at times is if there's a lot of, pressure, what will happen is they'll drive the prices higher, not lower, and that creates the squeeze. So ultimately what you're going to see here is pretty much people thinking, oh, this is great, no problem, I'm going to short this stock, it's going to go down because I know it will, and then ultimately they drive prices higher and force that shorter to have to buy it back, usually at a much higher price than they actually sold it for initially.
Yeah, and I think there's two things I want to clarify on that one. One is, if any of you right now are holding shares, so let's say you inherited 1,000 shares of Microsoft from a parent or something, and it's just sitting in your .com trading account or with a broker. When you open that account, you gave them permission to loan those shares out to someone else. And that someone could, let's say it was me who has 1,000 shares of stock XYZ, and I have it at my brokerage firm. Larry's also a client of that brokerage firm. He can, if the firm allows him, borrow those shares without my knowledge and sell those in the marketplace. That's called shorting. Now, ultimately, what has to happen is those shares need to be repurchased and put back into the brokerage firm. That's what is called short covering. Now, this little thing that you heard about in the media, which was this short squeeze, was basically some user group on the internet, which there are thousands of them. This is just one that garnered a lot of attention because of what they did collectively as a group of thousands of traders, is they found a company that had a lot of what's called short interest. Now, what's short interest? Short interest is the percentage of the float, meaning the total amount of shares out there that are short. So for example, if you look at somebody like GameStop, GameStop had 48 million shares available in all of the world. Out of that 48 million, 138% of those were short. That is an unbelievably high amount. So all this group did is say, this company has a very high short interest. Therefore, if we can buy and move price up a little, it will force those people who are short to buy to cover. When they buy, that pushes price up much, much quicker at an accelerated rate. That was essentially what happened. Now, let me get your perspective on this one, because I think this is the meat and potatoes of it. What I'm hearing so much about now is the retail investor has stuck it to the man. We're taking down hedge funds. We're taking back Wall Street. This is our day. And I feel like this is the little tiny ant screaming up at Goliath going, we've got you. And I kind of laugh a little bit, because in this short squeeze situation, we know that it hurt a couple of hedge funds, right? And certainly it's going to hurt a few. But if you were a big institution and you owned shares long of GameStop or any security that was being pumped by these guys, and you were looking to sell, what would you do? Would you stay at the price that you were selling at normally, or would you look at this influx of order flow driving things up and step back and let it run higher and then sell higher?
Totally step back. And I think this is a great example of they may have won the battle, but they're going to lose the war. Because ultimately, what the institutions are going to do now is they were taken by surprise.
Sure.
And as a result, they're going to make adjustments. They're going to change things up so this doesn't catch them by surprise again. I think the bigger question that you're asking right now is, does it make sense to do what's called FOMO, fear of missing out, and just drive that price higher? Or know that at some point the institutions are going to see price going up and they're going to step in and short down the market again. Right. So depending upon where you jump in, and this is why it's so important that you be educated, is that most people think it's a open casino where you can just jump in and people can make lots of money. Well, we saw this in the year 2000 with the tech bubbles due to Y2K. We saw it again with the housing bubble. In fact, there was a whole movie called The Big Short that really addresses all this. So this is nothing new. What should be new is before you take that leap and just openly throw money into the market, you need to be educated. And that's what we work our students on, in class, is making sure they understand that there's an imbalance at times between buyers and sellers. And we look for that imbalance, which gives us the opportunity to actually start looking at where does it make sense, and you've heard it your whole life, right? Buy low, sell high, that do we have enough information to make an intelligent decision and not just get caught up in the euphoria?
I think the important part here is making sure that as someone who does this on a regular basis, that we make sure that we do it from the perspective of being calm and level-headed. Most of the group right now in the hysteria is acting off of emotions, and they're making irrational decisions. For example, if we look at GameStop, for example, they're earning $4 or losing $4 per share, yet they were trading at $20. They're still losing $4 per share, and then they were trading at $480. An irrational mind says, hey, it's going to go to $1,000 because somebody tweeted it's going to go to $1,000. The rational mind says, this is out of line. Don't get caught in the emotional side of things. It will revert back to what's normal, and maybe I'll capitalize on the reversion back to normal, or I'm just going to stay out of it and look for something that's going to give me a higher probability of success. Unfortunately, what will happen to those people who were caught up in this hype, I mentioned this several times, is they're going to get caught holding the bag. And the institutions know this, right? The institutions are not going to say, hey, let's buy GameStop at $480 per share. They're laughing at that price. Now, the other side of this is the little guy says, hey, we've stuck it to the hedge funds. And certainly there are some hedge funds which were short, which did lose some money. But let me ask you this. If you're a hedge fund and you were happy shorting a company like GameStop at $20, and now it's $480, you might have lost a few billion on this short squeeze, but you're probably going to make it up 10x on this next. It's already gone from 480 down to 90, and my guess is in another few months it'll be back to where it should be in the teens.
Yeah, if you really think about it, Merlin, it's funny that you actually could see something fascinating happen to your point. And so the institutions, if you noticed, were able to acquire new cash overnight.
Yeah.
Most of us can't do that, right? We can't just go out and say, hey, Mom, Dad, can you wire me a couple of $1 million? No, right? So we have to be more intelligent that we need to understand how to manage our risk if we choose to do these type of trades. And most people are not trained as risk managers. They're trained to go in that market and try to kill it. And when you see these events happen like they do, and you see that price start to rally, more and more people just jump in. And that's where I think the institutions start sitting back and going, well, how high are these guys going to drive this up so that we, to your point, can make a whole lot more than just shorting it at 20? Now we have this opportunity to be up at 400 and think how much money we can make, and at the same time, how much the novices can lose.
There's an old saying in the marketplace that says, give a man a fish and he'll eat for a day, teach a man to fish and he'll eat for the rest of his life. This is another little third component to that. It's a little wrinkle, and it's basically the basket sitting next to the fisherman that's full of fish. And what happened in this situation, from my weird perspective, is the retail investor found the basket and stole the fish. And they're glorifying it, saying, we are amazing fishermen. We're the best fishermen in the world because we have all of a sudden all this fish and we didn't do a damn thing for it. The fisherman knows this. The fisherman will bait that trap next time, so the next time that the retail investor tries to grab from that basket, they are going to get their hands chopped off. Risk management is critical here in understanding traps in the marketplace. One of the things we teach about short squeezes. But we also teach about bull traps, bear traps, liquidity squeezes, volatility traps. These are all things that are risky components to the world of trading and investing. An educated investor understands these and says, I'm not going to run headfirst into this crazy volatile situation hoping to make some money. A logical, collective-headed person is going to say, I understand the risks that are involved. I will go slowly into this trade or this investment. I will make a calm decision on it rationally. If it goes against me, I'll get out very quickly, but I will stay in that as long as possible and make money on that trade. That's discipline, that's money management and risk management, something we're seeing a lack of from a lot of these online retail users.
Yeah, and most novices, unfortunately, don't have a checklist. They don't know what to be looking for, what they need to be asking the right questions. It's very scary out there right now. We see, lotteries over $1 billion. People are in this mindset right now, what if? And there's a lot of tough things going on right now. So to be able to use money, and let's face it, a lot of the new brokerage firms, they're offering zero commissions, fractional shares. It's giving the smaller investor a lot more opportunity to get in the markets again, but not necessarily teaching them how to be safe when they get into the markets. And that's, as you say, what we do with our students. We help our students understand how the markets work. More importantly, we help our students understand to look at what Wall Street says, what Wall Street does, not what they say, because they're saying one thing and most likely doing something different. Right. And so this is, I think, again, just been a wake-up call that most people are going to get in there thinking that they can take them down again. And there's an old Irish limerick I love saying, fool me once, shame on you. Fool me twice, shame on me. It's going to be a lot of shame on a lot of novices that they don't get educated to understand why this works in certain opportunities and why it may not be the best decision in other opportunities.
There's obviously going to be a lot of risk with this, and my hope is that by watching this, you have a little bit of better understanding of what really happened from a trader's perspective and not get caught up in the hype and the emotions of the financial marketplace. The truth of the matter is the institutions in the long run will usually win out over the retail investor, the uneducated retail investor, because they operate off of emotions. And when we look at the situation that's happening right now, Larry brought up an interesting point. He said millions, it's billions. One of the major firms that was hurt by this short squeeze received $2 billion from a clearing firm. Why would they do that? They're receiving that money because institutions are putting their money on the hedge funds, because in the long run, they were probably going to win out. We need to know this. We need to know the actions of it. And part of what we teach is understanding what the institutional investors are doing. If you follow the institutions, you see their transactions, their footprints in the marketplace, it gives you a better understanding of where prices are going to turn. Not just that some user group says, hey, this thing's going to 1,000, let's buy it. That's not real price movement. Now, also take it from this perspective. The institutions know darn well what happened. They will not relive the same mistake twice. What they're doing right now is position themselves in a way that they know what's going on in these user groups, in these Reddit groups, wherever it's at. Would name any of them. They're putting people in those rooms right now. I was actually on one of those chat rooms yesterday, and that was part of the talk track. Who in here is real and who's a hedge fund? Because now the hedge funds are going to start feeding information to these user groups. Yeah. Should you be scared? Absolutely not. This just creates another dynamic of market movement, things that drive price up and things that drive price down. The educated investor who understands how to capitalize on up moves will do well. Also, those that understand how to capitalize on down moves will do well. We hope that you learned from this. Hope that you guys get some great information and be safe out there with your tradings. Above all, it's about discipline, it's about money management and risk management, and we can teach you all of it.